Hey, gang, my name is Carl White. You're listening to Loan Officer Freedom, number one podcast in the world today for loan officers. And I'll be your host here for the next, give or take about 30 minutes. And I'm joined here today by a very dear friend of mine for quite a few years, Mr. Joe Panebianco, who I tongue twist on the Italian names, which is not a good thing, Joe, because I'm married to a 100% Italian woman. The good news is her last name is Salvo, or was.
Sure.
That was a pretty easy transition. So we affectionately call Joe around here Joe P. He's the owner of Annie Mac, a great mortgage company. And my tie-in with Joe, Joe, you're a really super humble guy, and so I need you to take off your humble hat here for like the next 30 minutes or so. You've got your pulse. Like anytime I have any questions about what's going on in the industry, or I hear something's going down, or hey, what do you think about this new thing that's going on? You're a great source for me. And I was wanting to give you a call anyway, which has prompted this podcast episode. Kind of give us an update of the state of the mortgage industry, and kind of, we've had some major motions here. Gosh, I'd say in the last 4 years, 5 years, just different set of challenges, but it's been definitely a moving target. So I thought we'd just kind of do a state of the mortgage industry and either A, put everybody at ease, or B, make sure they got their running shoes laced up, and maybe a little bit of both. So good to have you here, brother.
Yeah, let's do it. It's a pleasure to be here. Can't thank you enough. I will tell you that a ton of what I've learned and the value that at least the Annie Mac team gets from you guys has been tremendous in helping them execute. So where I try to focus my effort is on looking at the global landscape of mortgage originations, and then I leave the work to originate to folks much smarter and better than me. But
just different skill sets.
Yeah,
not smarter than you, my friend. Just different skill sets. So, hey, what is the state of the mortgage industry right now? We see a lot of companies are merging or selling or just closing up shop. We see others seem to be excelling. Where are we right now?
Yeah, I would say bizarro world. We're still sort of in that strange space. So you have to figure that, for the previous 2 years, prior to March 2022, the market took down basically 4 to 5 years worth of production in 18 months, right? And so now the market is completely morphed. And now what it's trying to do, it's slowly but surely trying to push its way through the snake so that we can get back to a normal market, right? And what is a normal market? A normal market is one where there's a comfortable balance between purchase and refi. And, just to throw numbers out there, I'd say it's something like 60% purchase, 40% refi is what you call a normal market. And we're not there yet.
Yeah. Where are we at that ratio? Have you seen what kind of ratios? And I'm not asking about your company, but like as an industry as a whole, where are we at with that ratio?
Yeah, if you look at Black Knight data, they kind of have us about 13% refi, 87% purchase. Now there are some areas where you see, a little bit more refi, cash out refi, probably higher loan balance stuff. But for the most part, we're still very much not in a refi market. All you need to do is look at the what's called CPR, the monthly prepayment amounts on mortgage-backed securities, and we're at historic lows. Normally it used to be about 6% principal prepayment every year, accounted for death, divorce, foreclosure. We're below 6%. So there's not a lot of refis out there. It is completely a purchase world. If you don't have a value proposition, or you're not out there servicing your referral partners and borrowers in the purchase segment, it's a bad place to be, which is why you see a lot of M&A, you see a lot of closures. Our forecast is one in which we're not going to see any significant change in a refi market until the end of this year, early into Q1. I'd argue we've been consistent with that forecast for the last 15 months or so. But there is opportunity for those folks that have enough production to cover their fixed costs.
Yeah.
And can, afford to operate with very slim margins, and some months losing money, some months making money. But at the end of the day, it's almost like there's this area. I don't want to get too political here, but there's this area in Ukraine they call the meat grinder. It's where these Russian and Ukrainian soldiers are unfortunately really just killing themselves. And we're still sort of in the meat grinder section of the mortgage industry, where people are doing whatever they can to capture that market share at almost any cost. But where are we in timing? You could make an argument that given what the Federal Reserve has done, over 500 basis points of increase, it's already starting to show some cracks in the economy. But the consumer is still very strong. That we're probably, at the end of the 7th inning stretch, beginning of the 8th inning of this, because eventually the Fed, at least historically, has always gotten its way. And they made it crystal clear that until inflation comes down, they're going to continue to attack the factors that they can. And it's going to continue to add cracks to the foundation. And our belief is that those cracks will eventually turn into leaks. And that's when we start seeing some easing up of interest rate conditions.
Yeah. So with all these, with many and seemingly some of the big players either going belly up or selling or joining each other. And this is not a question of anything that you might have going on. Again, we're just talking about industry broad right here. Like the companies that's in trouble financially versus those that aren't. Is the difference what you just said a few minutes ago? They're not able to scale up and scale down appropriately, or they're selling rates that there's no margin and they writing themselves out of business. Like what's the issue? I guess the question is, as a loan officer, how do I judge the health of the company that I'm with, and what should I be looking out for?
Yep. So really good question. All companies are a little bit different here or there. But I would say overall, first and foremost, if you look at the 10K or 10Q of all the public companies, which include everything from Mr. Coop to UWM to Rocket, some of these large companies, they all have one thing in common, which I'm happy to say AnnieMac has as well. It's they have a servicing book. If you don't have a large servicing book, you really struggle. So what does the servicing book do for you? One, it allows you to kick off a certain amount of monthly cash flow, which covers your fixed costs and originations. Two, as rates went higher, the value of those assets increased, and therefore you had, at least on a book basis, you had some profit. Those who do not have that did not. And last but not least, if you look at certainly the larger companies, they are continuous sellers of their servicing book. They're continuous sellers because they need to keep funding originations. So that is one very clear characteristic of people who have staying power. And I'd also say if you don't have your agency tickets, all three, right, you are not maximizing your execution. You're not holding on to sufficient servicing, and it's going to continue to impair those who don't. And the rest really just comes down to management. Nobody wants to be the first company to cut jobs. I mean, I can tell you, if I'm going to sit here in your podcast, I understand I have to sort of open the kimono, right? Otherwise, it wouldn't be truthful. It wouldn't come off as truthful. AnnieMac's done its share of cuts, and it's exceedingly painful. But it's equivalent of, and I'm not trying to make it seem like it's less than it is, but if you want to save the patient, sometimes the foot has to go, right? That's the reality of it. And the goal we at AnnieMac is to make sure that the folks that were, when it's opportunity, we have started to do, when there's opportunity to rehire, we rehire those good people back, right? Or we do our best we can. But having said that, you had to be quick, because you can burn through more profit in 6 months. I mean, you could lose more profit in 6 months. You can make profit in 6 months. The S curve of that gain loss is very steep. The second derivative of that function is exceedingly steep. So you have to be able to cut quick, and you have to manage your cost. You have to manage by actual metrics. So I would argue that listen, some of the best managers that I know are sales folks, but also some of the worst managers I know are sales folks. Meaning, they're not looking at the metrics. They're not managing it. If you're not measuring it, you're not managing it. So the other part of that is you need to know what your cost per funded unit is. You need to know where you can tweak the dial, where you can push capacity. where you don't want to push capacity because its service levels suffer, and then you become at risk in terms of taking care of your borrowers and your referral partners. So it is, that expression, New York, if I can make it here, I can make it anywhere. I would argue that it's, IMB. If I can make it in this industry, I can make it anywhere. You could take a successful IMB executive, and I don't care if you put them into, autos or cereal or fashion, they would probably do pretty well if they survive this.
Yeah. Yeah. I think it's the being able to react quickly, do those things that are painful, because I love your example. Sometimes you have to lose a foot, to save the patient, per se. You mentioned,
and I'll add one thing to that, Carl. It's not just as a company, right? It's got to be on the divisional and branch level as well.
Oh, for sure.
Right. So let's look at, we have branch partners, and they're great. And I'm actually very close with most of them. But some of them were faster to react than others, right? Some of them didn't want to believe that it was happening, or, what makes them really good salespeople doesn't make them, good operators in difficult times. So, the balance there is, you have to lead them down the path, to make the right decisions, and then, set them up for success later on. But so it's a long-winded way of saying, you can't just sit at the top of a corporation and say, we need to make cuts. It's got to be systemic. You have to go through the organization. First and foremost, they have to understand. They also have to be willing to make those cuts and do them in such a fashion that they're not burning through gobs of capital in order to do that. So, sorry, I interrupted you.
No, that was perfect. So you mentioned a few minutes ago some of the online lenders in today's market. How do we, as the day-to-day loan officer, how do we maintain competitive advantage in the mortgage market? Again, given the rise of some of the online lenders, how does a Jane and John Doe loan officer continue to have a competitive advantage?
Yeah, we have a national housing market, but we all understand that it's really a town by town real estate market, right? So, for us, we embed ourselves into the community, and we embed ourselves within the realtor community. And the reality of it is that if you look at the makeup of today's borrowers, and I don't care whether you are millennial, Gen Z, baby boomer, most people are really very fond of doing some things online. But the rest of it, they really want to do with a person, and they want to do with a qualified person. I would argue that, I'll make a reference to a flight to quality. For those of you who are follow the bond market, stock market, you'll notice that when bad news comes out, the stock market may sell off 1, 2, 5, 10%, and there's a flight to quality into bonds. That means the price of bonds go up, the yield goes down. And I would argue that the real estate market today is very much like that. There's a flight to quality, to loan officers that really understand the market. They understand the town. They understand the needs of the different demographics within their lending community. They have access to all kinds of tools to do things to help the borrower either get down payment assistance, do buy downs, repair their credit, or at least improve their credit. And so it's very difficult for the call center groups to do that. There's some wonderful call center groups out there. I would argue that Quicken is the single greatest mortgage company that has ever existed within the refi space.
Yeah.
Right. However, Quicken is not killing it. All we have to do is look at the recent quarterly report. It's improving a little bit, but they've cut a ton of expenses. It's because when you break the link between the consumer and the mortgage professional, and the triad, you have the real estate partner, the borrower, and the mortgage person. If that link is broken in the triad at any different place, it comes apart, right? And the call center folks are struggling to do that, unfortunately. And I take no pleasure in that. I view us as all, we are all bees sharing the same hive. So the fact that one group's not doing well versus the other, I've never subscribed to the one area is better than the other area is better than the other area. There's 135 million homeowners. They all need a service. We all provide different levels of service, and it just makes it better for all.
Yeah. Yeah, I think you're right. And I've always thought, like, for me, it's like, look, I can't speak for you, but for myself, I'm not going to compete with Rocket Mortgage on online searches or on online ad spend. Like their budget is obviously way beyond mine, right? So I'm not going to win against that game. So I'm not even going to step in that arena. But on the relationship part, the relationship like with the referral partner, they can't do that, right? They're not set to do that. We can win that game. So fight the battle that we can win. So I think we're on the same page there. Hey,
I'm gonna highlight that statement with a fact. So how much do you think Quicken has spent over its lifetime trying to market its name out there?
I wouldn't even know have a
$900 million.
yeah, that's higher than my budget.
A little bit, so a couple bucks here or there. But having said that, it hasn't penetrated the mind of the consumer that they should use them for purchases. Why? Because they go in there to the real estate agent. For some reason, the housing market's backwards. People look for a house first before they look for financing. I've never quite understood that, but having said, they go to their agent, right? Then they look for a house and then they qualify, right? And their agent's not going to send them to Quicken because their agent doesn't know Quicken. And I'm not knocking Quicken. I already told you, magnificent company, but it's that breakdown of that triad that's very difficult to solve.
Yeah, Quicken's always had my a standing ovation for me. I mean, they're if you want to get good, find out who's number one and find out what are they doing and learn lessons from them, and also learn where they're missing the because everybody's missing somewhere. So looking for their kinks in their armor that I would go after. Hey, let me ask you this. I was at a meeting a couple of days ago, and one of the loan officers was commenting about how it's really hard to win the builder deals because a lot of these builders have their in-house mortgage companies, right? And that's a whole nother topic, a whole nother conversation. My question is, how much do builder homes play into the market now? Is it an increasing amount of building, a decreasing? Is that something that I should concern myself with?
Yeah, it is. It is something that has to be on the radar of IMB. So historically speaking, there's existing home market and the new builds. It's about a 10 to 90% existing, 10% new homes. Okay. Now what I think we're seeing in today's market is about a 30% new home, 70% existing home, and it's my belief that that's going to continue to increase a little bit more. Now, we're certainly not going to see the inverse of that, but having said that, what does that mean, right? It means a couple of things. One, the average price of homes for sale in the United States, right? All homes will be higher than normal, right? Because the new home is generally about 15 to 20% more than an existing home, right? And so if you just do if the weight has always been 90-10, but now it's 70-30, you're going to have a different price. So that's going to be a little deceiving. People are going to start seeing some metrics. I'd say, please don't believe anything you hear on YouTube, anything you believe in the, on the news channels, because they're just not doing their homework. Because statistics, there's lies, damn lies, and statistics, right? And that's one of them. It also means that more and more people are going to have to get into the new construction phase of it, or they can make some repairs to their own home. But until the supply of existing homes increases, you're going to continue to see more of that again, that grinding move back to the norm, right? And that norm is not just a refi purchase mix; it is new versus existing home buyers. As yet another example, we're heading there, but it's a slow march.
So that's a remarkable increase of new build homes versus resales, going from a normal 10% market to a 30%. I mean, that's a 300% increase. I mean, it completely is. You have to remember, we're still at a very low level. So even modest changes make meaningful amounts. But having said that, yeah, it's a significant increase on a percentage basis for sure. If we were tracking, 6 million homes, 6 million existing units for sale, and then it was 30 million, it was 30% of new building, that would be something else altogether. But having said that, yeah, it's a significant change and not the norm. Yeah. Let's talk just for a few minutes about rates, because I know that's always a consideration that loan officers are thinking about. And so where do you see, like, our rates? I've seen reports where They think it's going to trickle down to like the mid fives by the end of the year, maybe the mid fours the end of next year. Where do you see that playing out at, and how does inflation play a role in that also?
Yeah, so therein lies the $15 trillion question, right? Where are rates going? So I'll say a couple things. One, the greatest minds in the world at the Federal Reserve, at the investment banks like Goldman Sachs, Berkshire, they're wrong, and they've been wrong for a long time. So within the context of that, you're now asking Joe Panebianco, who's not working at the Fed, but I do follow it closely. So what I try to do is I have a well curated list of folks and companies that I follow, and I do what you said earlier. I'm not trying to recreate what they're doing. I take the best ideas and the most intuitive thoughts that I see, and I try to melt it into our own forecast, knowing what I know about the world. So with that caveat in mind, two things are clear: that the Federal Reserve is going to keep going until it gets what it wants. I call the Federal Reserve the 800-pound gorilla, or a Hulk, and Hulk is going to smash until Hulk gets what Hulk wants, right? And what does Hulk want? It wants 2% inflation, or at least us trending towards 2%, right? Now, in order to get that, it's got to affect a sector of the economy that has no real influence on, which is the consumer, right? So it can go after housing, it can go after credit cards, it can go after autos, which it has done very well. But now it's trying to knock down an oak tree, using a butter knife, and it's chopping away. It'll make some dents, but so towards that end, the consumer is still relatively flush with cash left over from grants and COVID, things of that nature, as well as what they save by not having to commute, go to dry cleaners, spend money here and there. But at Wells Fargo published a really good perspective at the beginning of the year of where excess savings was. At the rate it's going now, it looks like they will deplete that sometime in August. And consumers in this nation are actually very interesting. They are undeterred by anything that's going to decrease their spending. There's a lot of revenge spending out there. I would ask anyone in your audience that's listening to this, as much as they want rates to go lower, I'd ask them, how many restaurants were you at in the last week? How many hotels did you go to? Did you take any trips? Do you have any trips planned? Are you booking are you buying stuff? And the answer is probably yes, right? So the U.S. consumer, they will not stop spending until they have no options but to not stop spending. And that's likely going to occur at the end of this summer. So what does that mean? Clearly you look at inflation in the short run, and we're going to have some inflation numbers that are going to get better. It's been no great secret for some period of time that the housing component, shelter component of inflation is about to get significantly lower. That's great. But the Fed no longer cares about shelter. It's dismissed that a long time ago. The Fed cares about shelter. The Fed cares about core inflation, X used cars, X shelter. And what is that really? Restaurants, bars, travel, entertainment. You want to see how the industry is doing. Look at the stocks of any company that, event companies. Look at the stocks of hotels, of airlines, like they're all doing well. So very long-winded way of saying, we believe that we believe that Hulk will smash sufficiently, whether it be through regional banks, whether it be through other sovereign defaults. It'll get down to about a 5.5% mortgage rate by the mid-end of the summer. And we're actually a little bit more optimistic on rates. We believe that when Hulk smashes, he tends to smash too much. It's had a history of that. And once unemployment goes up by 1 percentage point, it's 100% probability that goes up by more than that, because the Fed doesn't know how to do anything but sort of overshoot. So we're looking at maybe about a 4.75% rate heading into Q1 of 24.
That might kind of answer a little bit something else that I was going to ask you is like, when will sellers come back into the market? Do you think that's going to, there's no question the sellers, at least partially playing into it, they got a 2% interest rate, and interest rates are now 6%, and they hesitate on selling. When do you see that taking a turn, or has it already?
So no, it is not. So the second or third week of January, so the spring buying season begins with the winter selling season. The winter selling season usually starts the second or third week in January and goes away all the way through April, maybe sometimes into May. we've seen very little homes come for sale. I think right now, if I saw Altos Research is a group that does a really great job of publishing single family home stats. I'd look them up if you can, but I think they said there's about 420,000 homes for sale in the United States, single family homes. Now, you think of the depth of the United States, the breadth of the United States, 420,000 single family homes. And I often say all those homes don't have killer bathrooms and culinary kitchens, right? So there's not a lot to choose from out there. So then you say to yourself, okay, what's going to draw the seller out? Well, we know that 6.5% rate's not going to draw them out. There was a survey by one of the MI companies that I'll try to pull up and send to you for your teams that are listening. But most people, I think about 70% of people said they need to see a 5.5% rate in order to go back out there in the market, right?
Okay.
Let's assume it's about a 5% rate. And sellers need to be educated as well. So some of the things we have seen increases in consumer debt. No question about it. The average car payment, it's hard to believe, the average car payment in the United States is now like $1,100. Credit card usage has shot through the roof. So there is a scenario where a well-educated seller, you could show them that selling their house, especially if they bought in 2019, 2020, unlocks a ton of equity, which they can use to make a larger down payment on their new house, which they can also use to pay down a bunch of debt. They can wind up with a better house, less debt, and an equal or lower monthly payment, right? But that is a long process, Carl. The average seller or the average homeowner, all day long, they'll do a refi. Rate and term it's in them. They've been beaten down to it. There's champion mortgage days. They get it. Shout out to my champion mortgage friends out there. They get it and they're going to do it. But once you get past rate and term, cash out, they're a little bit more familiar with, but they're, and then the concept of getting sellers to understand that they could be a seller and a rate and term cash out at the same time. It's tough, but we go out there and we educate people on it. I think the direct answer to your question is we have to see interest rates fall below 5.5% before a lot of sellers are willing to give up that 3% mortgage and go to 5% mortgage. But there's a great statement that so I actually bring my dog to the office. A little story I'll tell you when we end this one. But there's so there's a great statement. If anyone uses it, if anyone uses it, I'd like you to pay a fee, maybe $1. But everyone's been saying for a long time, it's marry the house, date the rate, right? It's become almost cheesy, cliche. I think the new thing we're heading towards, and I'm using it in my presentation, is love the rate, hate the house, right? And there are a lot of sellers out there who may love their rate, but they're not thrilled with their house, right? As I said, they've got two 1980s styles bathroom, they've got a bad kitchen. They'd like to make some changes, but home equity lines are not inexpensive, I can tell you that. With the regional banking crisis, they're likely to have more difficulty getting it because banks just don't have the capital to put that stuff on their books right now. But again, it's an education process. But assuming nobody's going to accept any education, nobody's going to do the homework mortgage originators are not going to do the homework they need to do. Rates are going to have to be well below 5.5%, probably in the 4s before the 3% homeowner will make that adjustment. But one last thing I really want to highlight for your group is that unless you bought your home from March 2022 to today, like you've got a ton of equity in your house. If you bought even in 2020, 2021, between COVID and the end of COVID, March 2022, the average home was up 43% in price, 43% in price. And over the last year, the average home is basically flat. Now, jumbo homes are down a lot more than starter homes. You could do that math all day long, but there's something to be said for the fact that there's a ton of equity out there. It's still out there, and sellers need to understand that that's a tool for them, but it's a slow process.
So it sounds like a big part of the loan officer is to educate them on using that equity. And I like what you said, how you could use the equity on your current home as part of a cash out to debt consolidation and to be used as a down payment on your home. That'd be a great thing to information transfer to our
If,
prospects. Hey,
if
let
you
me.
bought a $500,000 loan, and if you bought a $500,000, if you have a $500,000 house, and you bought it in 2019, you now have $250,000 in equity.
Yeah.
Think about that. That goes a long way, that money.
Well, you said something else too that just blows my mind. That totally off topic, but I wrote it down here. The average car payment's $1,100. That just absolutely blows my mind. That's just, what are people thinking? Right. That's what I ever since you said that, I had no idea it was even remotely. I haven't had a car payment in probably 20 years. So anyway, hey, we're here at the top of the hour. What is one key takeaway or piece of advice that you would share with loan officers to help them succeed in today's mortgage industry? Like if they're looking to increase their market share right now, what should they be thinking or doing or acting or not doing? How do I get market share today?
Yeah. So, I actually use this analogy today, and those without kids, small kids probably won't get it. But there's a movie called Madagascar.
Yeah.
And in this movie, Madagascar, there's a scene where, the lion and the zebra are good friends, but there's a herd of zebra out there. And he's trying to find Marty the zebra, and he can't find him because they all look the same, right? And he gets all offended by him. And I would say that herd of zebra, they're basically loan officers today, or mortgage companies, right? Because they have no unique distinguishing feature about them. They're all singing the same song. Yeah, I've got this rate. I'm a quarter better here. I'm an eighth better here. I've got blah, blah. And the reality of it is, each individual company and each individual loan officer has to find their own value proposition. Mm-hmm. So I can't speak for others, and this is sort of a cheap plug, I guess. But I will tell you, what Annie Mac has decided to do is we've decided to create, 18 months ago, we created a cash buyer program. Without getting into too much detail, our cash buyer program allows us to look like a stallion in a herd of zebra, right? So we could turn, I have a separate company on the side. It's more than we want to get into in this podcast, but we turn an average buyer into a cash buyer. And what that does, it distinguishes them from the crowd. So couple of quick facts, 32%, according to Fortune magazine, last year, 32% of all homes were purchased with cash, so about a third. Historically, it's been about 25%, so it's increasing, as you can see. It's a pretty significant percentage increase. And on top of that, about 90 or 95% of all people, all sellers who have a cash offer or a financed offer, take the cash offer. No great surprise there, right? Who wants to deal with a but you also, you have a chance of getting up to 12% less with a cash offer. You're paying 12% less and a 90% higher conversion rate. So why would you not do that? So at least that's Annie Mac's way of doing that. It's worked very well. The folks that are doing that, the mantra in the market 2 years ago used to be narrow and deep. Keep your referral partners, go really deep with them. Now the mantra in today's market is to go wide, right? Because these people only have so much business, right? So now you've got to go wider, and you can't go wider on the relationship side, Carl. This is something you've taught forever, right? But how do you go wider on the relationship side? Well, you can offer rock bottom rates that no one else could get. I don't know how economic that is, but shoot, that's definitely a way. Or you can offer something with value. So if your firm doesn't have a cash to keys program or doesn't, I would, try to find something of real value that nobody else has other than great service and competitive rates, and get out there and do it. Because I'll make this last point is, every loan you do right now is going to be, if you handle your book of business right and have the right tech stack behind you, a refinance in 3, 6, or 12 months. You've all heard it before, same one, but that's the reality of it, right? If you originated a loan, we don't need rates to get down to 3% to take that 6.5% mortgage down to 5.5 to 4.5. And I'd argue that as loan sizes have increased, the sensitivity to prepayments is much lower. You don't need 50 basis points to get a little bit of savings. And given the fact that the economy is at least going to slow down to trend or below trend, people are going to want to take advantage of lower rates to lower their fixed monthly costs. So You
Yeah.
know, I'll leave it by saying that there really is a ton of opportunity in this market. You have to mine it and dig for it and sift through a lot of it to find the little nuggets of gold, but there are opportunities out there. And you look back forward, look at the top 50 lenders of America right now, and in 5 years, look at them, and the difference between those today and those 5 years from now are going to be the ones that are making the most of today's market, LOs and companies alike.
Yeah. Brother, a lot of really good stuff there, Joe. I always appreciate talking with you. And just in case somebody's not familiar with it, on the program where you in essence turn all of your borrowers into cash buyers is just a 30-second explanation of that. Is that basically like if I got a contract on a house, you guys go ahead and just pay cash for the house, and in essence, I do my loan like a month later, or a week later, or something like that?
So what we do is we will take a look at the house. We won't do every house, obviously, because there's some risk factors in there. We will ensure that loan closes, and if it doesn't close, we will buy the house, and then sell it back to them. And some, there's some special sauce in there that I don't know that I necessarily want to shoot out there, but I will say that it's an evolved process. It took us a number of months to get up. I will tell you, we made our mistakes, but luckily we made them in a time period where home prices were still rising pretty quickly. But having said that, it's a process, but it does work, and the folks that use it in our firm, they either win the property or they come in second. But again, that approach might not be. I'm not here to pound the table and say Annie Mac's got this.
I get it.
I'm here to tell you that you, as an individual, as a loan officer, as a branch manager, as a divisional manager, and as a CEO, you need to find something something of value relative to today's market needs. That's gonna make you gain market share. Sort of like, Henry Ford's got this great saying. It's if I'd asked the people what they wanted, they would have said more horses, right? Mm-hmm. Or faster horses, whatever the expression. And I'd say the same thing occurs to this, like, don't worry about what everyone else is doing. Find out what's going to work for you and do it. Because by the time you wait for everybody else, it's going to be too late.
Yeah. I think that's really the bottom line, is just go do something, right? Just the days of running the fishing boat down the river and the fish jumping in the boat. We've moved past that, at least for the time being. We've moved past that. And there's an old saying, action is the first symptom of desire. Do something, right? Do something, right? Do something. So, Joe, you're always such a joy to talk with. I really appreciate you carving time out of your schedule. You're just a very dear friend. I value your input greatly, and you're absolute class act. So I really appreciate you, my friend. Anything I should have asked you today that I didn't ask you?
No, I think we're good. I want to thank you for being a great mentor to all the troops. You really are the class act, and this isn't just a love fest between Carl and I. We go back and forth on who should be the most grateful and who the most humble is, but Carl's got an enormous amount of insight. I've learned an incredible amount from him and his team, and I'm just happy to be associated with you guys. So thank you very much for your time today.
All right, my brother. All right, I appreciate it. All right, gang. Hey, Joe, if somebody wants to reach out to you or reach out to the organization or something, how would they do that?
Yeah, you can reach out to me, jp@annie-mac.com. There, or just log into the web. There's a number of different. I'm also on LinkedIn. Obviously, you can reach me there as well. But even if you're out of, if you are at Annie Mac or not at Annie Mac, and you have, questions, general questions, it doesn't matter. Like I said before, I believe we're all bees of the same hive. So if we can help each other out, now is the time to do it. I'm always available.
Yeah, I appreciate, brother. You're a class act. All right, gang, thanks so much for listening in. Anybody, one thing that we will ask you is a favor, that anybody you think, any of your loan officer friends you think would benefit from this conversation, which would be everybody, they'll appreciate if you forward it to them. I certainly will too. I know Joe would too. And so, and also, we always appreciate those reviews. We're number one because of you guys and giving us those great reviews, because that helps the algorithms and the machines to get the podcast out yet even more. And so we can have fantastic guests like Joe here, knowing that we have a pretty good sized footprint these days. So thanks again. I appreciate it. Joe, we'll talk to you soon, buddy.
Thank you, folks.